Stephen. It's wonderful to have you on Floor Talk. Thanks for joining me today.
Thank you for having me. It's a privilege to be here with you.
Thank you. So now let's start off by talking about Valley Capital. Tell me about it.
The history behind it is really from the founder, Steve O'Hara, who back in the 1990s was a founder of 3 companies. One of them got acquired by Oracle, another got acquired by Micron, and another got acquired by Q-West. And all that time, and since then, he's been an angel and a venture investor. And he spent all those years developing incredible relationships, a number with whom are current LPs. He finally started Valley Capital in 2018. I wasn't the obvious hire, given sort of my background and being stationed in Hong Kong, but to his credit, he feels that venture capital, it's all about relationships, not only with the founders of your companies to serve them after you make the investment, but also with your LPs. We are very different in the context. We are focused on late seed and Series A. We are not the spray and pray strategy. We do not believe that investing in 40 to 50 companies per fund and hoping for 1, 2, or 3 successful outcomes is the way to do it. We are totally the opposite of that. We are high concentration bets into only 8 to 10 investments per fund. We diligence them extremely intensively through our 3 lines of diligence, the investment committee, extensive customer feedback, and we seek advice, finally, if they make it to the 3rd level, from our prominent LPs, which provide us with incredible guidance and judgment, given the fact that a lot of them are global business as well as technology leaders.
Now, Stephen, tell me, what factors do you prioritize when investing in companies?
It's basically 5 things. One of them is the product, the technological innovation, and the technology in and of itself has to be superior. Oftentimes, and you can see it today, AI is a very, very, strong and widely used buzzword, but the reality, AI is going to be here to stay. But the reality is there's going to be a lot of success, there's going to be a lot of failures, and the way that AI is moving so quickly and so fast, it's very difficult for companies to stay relevant given the rapid pace that AI is growing. And there's a lot of factors that drive into that. So we ask ourselves in the best way we can, is this technology truly, truly generational, and will it be relevant 3, 5, 10 years out? And we have to make a judgment on that. Secondly, we look at the market size. For their particular product, is the market addressability very, very large on a global scale? And if it's not, it's very difficult to have scale with their product reach, and that's something we take very seriously. Thirdly, financials. A lot of firms, don't really take the time to diligence the financials, but we believe in looking at like certain thresholds. If you can achieve an ARR of, let's say, $5 million on $1, $2, $3 million of investment versus a company that's spending $10 to $20 million to only achieve a couple million of ARR, well, that latter company is not something that we want to touch because it's a very inefficient use of capital. As also too, many times, or even early stage companies, look to leverage, and that's a dangerous thing, particularly for an early stage company. Also, the 4th thing that we look at is the team and the management team. It's really about the DNA, how thoughtful they are. Is this a person, she or he, that in rough times can navigate the company out of trouble? Because in an early stage, it is a leap of faith. You're in a rapid stage of growth, but oftentimes the technology may not be tested with a wide group of customers. So the fact is that we really need to believe in the founder that she or he can really navigate the company through their very difficult times. And lastly, it's all about culture. Is the founder and the founder's company, the team that he or she has built, do they have a sense of urgency, right? Are they really hungry to make this work? And are they really obsessive about their company and their product that they're trying to build? And we think that those 5 key metrics are very important in analyzing, particularly in early stage where we invest in. And that's the way we kind of look at things.
Now let's pivot and talk about trends. What trends are you currently seeing in the tech startup ecosystem?
Well, obviously AI, generative AI, with its coming 2 years ago in 2022, we saw ChatGPT, all forms of AI. And the reality is with AI, it's almost like you and I are talking here, Judy, and it's 1992, and we're talking, what do you think about this internet thing, right? AI is going to be here to stay, no matter what people think. It's going to have ups, it's going to have downs, it's going to have bright days, and it's going to have extremely dark days. And there'll be successful companies that do it, and there'll be non-successful. But the reality is, it has been and will continue to impact all industries in a very profound manner. And so we obviously look at the high growth areas where AI is impacting, like enterprise technology, cybersecurity, as well as data analytics, and how AI impacts the consumer in terms of customizing consumer experiences. And when we look at companies, and particularly our area of focus, which is enterprise technology, next generation cybersecurity, workflow automation and technology, if you look at one of our companies, Rapid Canvas, which we had the privilege of making the seed investment in 2023, this is a company that is an end-to-end data solutions founded by Rahul Pangam, who has spent a number of years, 12 years ago, at Google's anti-fraud unit, founded Simility, did very well, ended up selling that to PayPal, and then worked at PayPal for several years with his team, performed immense KPIs, and then founded Rapid Canvas in 2022. Today, or what has been over the past couple of years, for people who want to use data in order to establish the code or invent the code, you would either have two choices, by and large. You'd either have to hire a small army of MIT, Stanford, and Harvard PhD graduates to do the code for you, or oftentimes you would outsource it to a very large company like an Accenture or a Palantir that comes with a very high fee. They do exceptional work, but it's a very high cost, and it comes, usually a year to 2 years of work. But with AI, Rapid Canvas now has used AI, and the AI agents are actually establishing the code. So now with Rapid Canvas, companies can have essentially the same results that you would have gotten from a small army of PhDs or outsourcing it to a larger data analytics company. And they can do it in-house now at a much cheaper cost with only 1 or 2 IT professionals, because the AI already does the code for you.
Finally, Stephen, tell me, how does Valley Capital support its portfolio companies beyond funding?
So that's actually our special sauce, and why I left Goldman Sachs to actually join Valley Capital Partners. If you look at most of Silicon Valley, or most of the VC funds around the world, a lot of them have become very large, with very large AUMs, and have become essentially growth funds. The reason is because a lot of companies in the United States now, about 80%, are remaining private. And so in order to help finance the growth of these companies, these venture capital firms have had to become very big with very large AUMs, because when you're funding a company at Series D, E, and F, the ticket size is substantially larger than at the seed and Series A round. But what has happened is a lot of those firms typically invest in 40 to 50 companies per fund. And what that leads to is they think that they're playing the probabilities. If I invest in 40 to 50, the odds of me hitting a Harry Potter and a Da Vinci Code are very high. We at Valley Capital Partners feel that's misguided, and we don't think that's the right strategy. So we create early stage alpha, and what that means is that we focus on late seed Series A investments. We only make 8 to 10 investments per fund. Average check size is $3 to $6 million. But the difference is that when we make an investment, our culture is to spend an exorbitant amount of time with the founders to help them, advise them on how to navigate through the difficult times, advise them on strategy, advise them on financing, and in my case, to help them grow in the Asia Pacific region. That's why I chose to still be based in Hong Kong, because a lot of our companies, like Factify, like Rapid Canvas, like AIM Security, all want to expand in the Asia Pacific region because it's a huge market. And having a person there to help facilitate that and handhold them through that, through my own connections of working in investment banking in the region for 25 years, I'm in a good position to help do that. But that's the difference, is that when you invest in 40 to 50 companies, you don't have the bandwidth to actually spend that time with 40 to 50 founders. So what ends up happening is a lot of these venture firms make the investment, but they don't have the capacity and the time to help and handhold those founders through the difficult times, let alone helping them expand their business. So we believe that a concentrated portfolio bet on only 8 to 10 companies with heavily intensive post-investment support is the way that venture capital should be done. It's the way I think a lot of the larger firms did it 20, 30 years ago, that they've moved away from that pasture, and that has created a huge opportunity for us.
Stephen, it's been wonderful to talk with you.
Thank you very much.